And FHA was literally rendered useless because people didn't need that insurance anymore, because now you had no documentation loans, you had these arms, you had all of these teaser rates that would get people into a mortgage, with people out on the street saying, don't worry, just sign on the dotted line. Many of our people were seduced into mortgages they could not afford. And when they reset at a price that no way they could hold on to them, because now the financial institution not only is, refinancing the loan, they have what is known as a margin. And I was shocked when I discovered that we have no regulation on these margins, and they could get 2 to 3, maybe even 4 percentage points. They tell me about 2.5 or so higher. I just saw a product that shocked me still. It's a product that someone had with interest only for 5 years, and then after 5 years it reset to this adjustable rate, and the rate adjusted every month. And it could go up to 10.25%. No less than 2.25, but all the way up to 10 point. That's the kind of trash they dumped on us. And people got into these, and there was no refinancing. The persons could not afford the loans when they got into them. And so certainly they were not going to be refinanced. Thus, you have all of these foreclosed properties all over the country. And when you look in Ohio and Michigan, you will see the worst example of what happens with these exotic products anywhere in the country. In East Cleveland, 40% of all the mortgages, you told this story yesterday, and I did a hearing up there, 40% of all the mortgages that were extended to basically black people are in foreclosure. So that's 40%. Really what's happening, what has happened. A lot of people made money along the way. A lot of people, because they were packaged, securitized, and the initiators of the loans didn't keep that paper. That paper was bundled, and Frank can explain tranches to you. And they invested in these tranches, and it had all kind of junk in it, and it didn't matter. It's gone. And then the servicers get their hands on them, and the servicers are detached from the people with the mortgages. Their job is to collect that money, to charge those fees, and to get that money, make sure that the investors are made whole. Well, I won't go any further than that because I know that you've got a lot to talk about here, but I'm focused on the services now. Yes. I'm focused on the services because they're in control. They have the power to do what I call workouts or modifications. And in this bailout, I think I'm looking at a creative way by which to make sure they have the capital, because they have to pay up front on these. They have the capital to do real modifications and workouts to keep people in their homes, because what we have set up so far with Neighbor Works and all of that's not working, and we're not getting it done fast enough.
Thank you. I hear, first of all, we want to thank you for your leadership on the House Financial Services Committee, where you've been a persistent, consistent leader and advocate on behalf of African American homeowners and all homeowners who've borne the brunt of this problem. And we really want to thank you for your leadership. What I hear you saying is that our old nemesis, Jim Crow, went into a telephone booth, put on a suit, put on a nice starched shirt and a tie, put on some Sarah Palin glasses, and came out and reintroduced himself as James Crow, Esquire. And that's what I hear you saying, that there was an element in this of abuse and racial discrimination.
There was certainly that, because the institutions are basically white. But I want to tell you, one of the things that disappointed me somewhat as I looked at all of this is we had brokers on the street who looked just like us,
yes,
who took these toxic products and marketed them to our people. And that kind of broke my heart when I learned that not only did we have people looking like us putting these products on the street and encouraging people to sign, what we're discovering there was fraud in a lot of it. And so one of the things we should say as we talk about this issue is there comes a point in time, even when you're making money, when if you are interested in community, if you're interested in helping African Americans, you don't take products and you don't get involved in activities that's going to rip your own people off. And so I think that, like I said, we all have some blame in all of this.
Let me come to Mr. Parks, then to Mr. Raines. Mr. Parks, I wanted to pose this. The Federal Home Loan Bank Board is connected to a lot of community financial institutions around the country. And I wanted you to comment in general, but also talk a little bit about what you see with the community-based financial institutions around the country in terms of this problem, but also in terms of possibilities for fixes.
Sure. Thanks, Mark. I'd be remiss without making a couple of comments that I think Congresswoman Waters is too modest to really take claim for. Not only is she worried about what's going on with the housing world and the subprime world, she's also spending a lot of time in this bill looking at who's going to get these assets afterwards, and whether minorities are going to be able to participate on the back end in the $700 billion bailout, which has been part of her legacy. And also, I think that she's not taking all her credit for what she's done in talking about the beginning of the story, which is that so much of the capital that occurred to be able to shift into the subprime world really came out of Congress's efforts when Congresswoman Waters and others were in the minority to downgrade Fannie Mae and Freddie Mac, put caps on their portfolios, and to expand Wall Street's engagement in this sector. At one point in 2000, Fannie and Freddie and the GSEs were about 73% of the marketplace. By 2006, they were down to about 40% of the marketplace. That gap, that changeover really occurred when Wall Street was allowed to basically be the source of capital for a lot of these mortgage brokers who engage in the activities she's talking about, and also changed the product line. The product line shifted, and that's not to make Wall Street sound like they're the worst people in the world, but their goals were just not in line with the housing goals. The reason why the GSEs existed, including the home loan bank system, is that they had a twin mission. They both were to make a profit, but their mission was their guidepost, which was housing Americans. The fight had traditionally been one in which we were making sure people of color were included in the housing of Americans.
That's right.
That game shifted in 2003, 2004, 2005 during this administration, when the game became just one of how much profit can you make in this sector. Right. And Wall Street's focus was not a mission focus. Wall Street's focus was, and therefore the advent of the no-doc loan, the advent of the interest-only loan, products that by and large existed for the wealthy. And they were really existed for tax management purposes for a very elite group of people, were then mass-produced. And once they became mass-produced, a lot of maladies that exist in all communities came to the forefront. One was people were able to get more house than they normally would be able to afford. So, your desires could be met for the first time. You could have the 5-bedroom home, blah, 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 because you can only put this much down. And so you lost sight of fundamentals. By Fannie Mae and Freddie Mac being out of that business, quite frankly, where they acted as informal regulators, because they basically, through their seller servicer guidelines, determined, we're not comfortable with these ratios. That kind of discipline went out the window.
That's right.
Funding went through Wall Street. Wall Street looked for a profit. They were looking to make a security like Congresswoman Waters talked about. They could pass it on. They didn't have to deal with the consequences of the action. Come back to the home loan bank system and what our members are about. You basically have portfolio lenders who Congresswoman Waters spent the first 15 years in Congress beating up on to make sure they actually made loans in our community. And because of her efforts with CRA and HMDA, they realized there was a market there. And then they spent the last years in her career trying to reward them for the activities that they actually do by engaging in character lending, sending them mortgages to us, and we hold them in portfolio. It's kind of the old-fashioned lending model and creating a banking relationship. So as they go through this challenge, I think a couple things Congress is looking at. Do you want to reestablish banking relationships between working class and middle class communities and lenders? And that means that you question whether the mortgage broker model makes sense. Secondly, with the Fannie and Freddie and the GSEs in general, do you really want to empower those institutions that basically in the last year were really responsible for 80% of the mortgages that were made, and B, that really were the informal regulators of the mortgage broker operation through the seller servicer guidelines, or do we want to continue with this Wall Street model that we've now known is a colossal failure? The irony is progressives like Congresswoman Waters and Congressman Meeks beat away at the notion that, in this space, there's market failure, and what are we doing? And why are we doing away with the GSEs? I think one of the things that, because they're in the middle of this legislative fight, they're not able to say all the time is that they were right. The right wing was wrong.
That's right.
And I think that's how we got in the position.
Congresswoman Waters, I know you are in discussions today and you may have to excuse yourself. If that's the case, we want to thank you so much for what you've done. Thank you for your leadership and thank you for coming. Can you stay for a bit?
Just a short
bit.
while.
Thank you. Let me go to Mr. Raines.
Well, in addition, first, I think Congresswoman Waters gave you in the shortest possible time the most in-depth explanation of what happened in this period and what happened to real people in their communities. But as she implied, and I just like to emphasize, that as much as race and racism had to do with this, the almighty dollar was the engine, was the fuel really behind it. And we should not ever allow anyone to point at homeowners and say they are the cause. Because you wanted to own a home, somehow you caused Wall Street to melt down. Because Wall Street can melt down and has shown it can melt down without your help. It's done it again and again. I spent the entire decade of the 1980s going from city to city and state to state because they were all going broke. And part of why they were going broke, and my clients were, people like Harold Washington, the first black mayor in Chicago, and the state of Texas and elsewhere. There was a mania about municipal notes and municipal bonds, and that went off and blew up. Anyone remember junk bonds?
Yep.
Yeah.
Remember that? Remember Drexel Burnham?
Yeah. Yeah.
There were no homeowners involved in junk bonds. That was about another mania, another effort to try to get rich quick, to try to take a product that made sense in one context and do it in a different context. People remember third world loans. Remember the dot-coms.
Yeah.
Homeowners didn't do any of that. The only reason the crisis today is so big is that the mortgage market is so big. But it's not because there's something that the American people did wrong by wanting to build wealth by owning a home. And by the same token, the cure to this cannot be to punish homeowners who are the victims and not the people who brought on the problems. There are millions and millions of people who could afford their mortgage if they'd gotten a conventional mortgage or they'd got an FHA mortgage at the beginning.
That's right.
Millions and millions of people. So part of what we have to do is to take this toxic waste and turn it into something that can support home ownership again.
That's right.
Personally, if I were writing the bill, which I'm not, thankfully, I don't have either that responsibility or that burden. I believe there needs to be a way to facilitate what Congresswoman Waters was talking about in working out these loans. Because what we have to do is find a way to finance the good assets that financial institutions have. In the short term, finance the bad ones and then work them out. And what I would propose is a direct grant program, $10,000 through nonprofit agencies where they're sitting side by side with the homeowner able to negotiate in this process of revamping these loans.
Let me thank them, and we've all been joined by Stacy Tisdale. Stacy has reported on business and financial issues for more than 15 years, authored a book titled The True Cost of Happiness, The Real Story Behind Managing Your Money. She's a financial expert on NBC's Today Show, that's where I saw you, and for CNN and a number of places. Please recognize and greet Stacy Tisdale. We also are going to be joined by the mayor of Durham, North Carolina, Mayor William Bell, who is with us. Mayor Bell, come on out. And Mayor Wayne Hall of Hempstead, I believe this should be New York. New York. And Ms. Marcia Griffin, president of Home Free USA. Are they with us? Not yet. Well, when they do, they'll join us. I've got my next question for you, Mr. Eve, you, Ms. Tisdale, and you, Mr. Wade. These terms, counseling, financial literacy, financial education, there's a two-part question here. One, to what extent did financial illiteracy, lack of understanding, contribute to this problem, number one? And number two, talk a little bit about what you think when we talk about financial education, financial literacy, and home ownership counseling. When we think ahead, what should we be requiring, providing, and ensuring to empower people with information in the decision-making process? Let me go to Mr. Eve, then I'll go to Ms. Tisdale, then to Mr. Wade. Mr. Eve.
Thank you, Mark, and thank you, Congresswoman Waters, for your leadership. I can't move on without commenting earlier. I left Brooklyn, New York about 4:30 this morning, and my wife said, why would you be going as a financial services institution to this audience at this time, given this level of volatility? And the best part of my job is that I spend 80% of the time in communities that look like ours around this country and over the last year around the globe. So this is where I need to be. And the message coming back to Mark's point, we support the legislation. We understand that changes have to be made to this to the bill. But I'll bring this back to Mark's point. Once Congressman Waters and Greg Meeks and others are finished negotiating, and once something is passed, you and your communities have to be ready to come to people like me at Citigroup or Bank of America, whatever the financial institution is in your community, and say, all right, now what is in this for us? You have to hold us accountable. And one of the ways that you hold us accountable is encouraging us to partner with nonprofits like Ken Wade. Mark talked about financial education dollars. There's over $100 million in housing counseling in this not the most recent bill pending, but the one passed in the spring. In November, there'll be 3.92, and Congresswoman, correct me if I'm wrong, nearly $4 billion in community development block grants. And this will help nonprofits in local communities around the country purchase, renovate, rehab, and then sell or rent these properties to local communities, ideally low, moderate income communities. And as I travel around the country talking to organizations like many of you represent, I said, are you ready? Do you know about this $4 billion? Do you know about the $700 billion? Do you know about the $115 million? And often people say, well, we didn't know. We just don't know. So if you don't take anything away from today's discussion and the caucus weekend, know that you have to go back home and ask the tough questions about, all right, what is the impact going to, if the bill passes, and if the president signs it next week, and if negotiations are successful, what is going to be the impact in my community? And begin organizing around those issues. To Mark's question about financial education, growing up in my household, and Ms. Waters has known my father for the better part of 20 years or longer. My financial education growing up was neither a borrower nor lender be. Anybody ever hear that before? It's actually taken from a Shakespearean play, but that's what my dad's guidance to me was growing up. And so I've been at a financial services institution for a few months, learned a little bit about financial education, and gone back to him and said, hey, Dad, growing up, all your financial advice was neither a borrower nor lender be, And I said, well, now I'm working at a big bank, and I've got a little knowledge here. I'm dangerous. And why didn't you ever impart any of this financial education to us? And he said simply, when you don't have much, there's not a lot of decisions to be made, right? So wasn't a lot of debate in my household on where to invest or where to save. You're trying to figure it out But I said, well, actually, no. What I've learned is that when you have less, you need more education to figure out how to manage, in fact, with what you have. And so that's the message that I'm imparting to my children. And all of your organizations and all of your communities have a trust and credibility. And I don't want to lie to you. Ms. Waters mentioned earlier, Mr. Meeks prior to her, there is a huge loss in trust and credibility over the course of the last year or two, all around. Plenty of blame to go around. But you and your communities have the opportunity to bridge that gap with the trust that you've built and manage these resources and provide the types of financial education, the types of financial literacy opportunities to communities that we so desperately need. So there is plenty that has gone wrong in the past, but looking forward, we have to figure out in our communities how best to make the best of a very difficult situation in the months and years ahead.
Thank you, Mr. Eve. Let's give Mr. Eve a hand, and thank you. Before we go to Ms. Tisdale, Ali Solis, Vice President of Public Policy and Industry Relations for Enterprise Community Partners, is joining our panel. Ms. Solis. Mr. Lee Bowman, the National Coordinator for Community Affairs with the Federal Deposit Insurance Corporation. Let's greet Mr. Bowman. And Mary Lee Widener, the President of Neighborhood Housing Services of America, joins us. Please greet them to join our discussion. Let's go to Ms. Tisdale on financial education and financial literacy.
Thank you. First, I'd like to thank Honorable Corinne Brown for putting together this important and timely panel and for allowing me to take part. And I'm very honored to share the stage with such a distinguished group. I've been a financial journalist for over 15 years, and I've analyzed and pulled apart the economic boom and real estate boom we enjoyed a few years ago. I've analyzed and pulled apart the economic crisis that we're facing right now. At its heart, this is a story of financial illiteracy. People signed up for mortgages they did not understand. They didn't understand how their debt levels could change and how quickly that could happen. And we are actually seeing some states require some form of financial counseling before consumers can take on loans. But I urge our lawmakers to let financial illiteracy move to the forefront of this discussion. We have to devote more time, more money, more attention to a lot of the financial education programs that exist. A lot of the nonprofits out there that are doing this, there need to be more of them. And what's very interesting when we think of financial education, we focus a lot on the numbers, and that's very important. People need to understand how these basic instruments work. Well, I conducted a 6-year study on what's really at work and our choices about making and spending money. And what I realized that most of our financial problems have very little to do with money. One of the biggest influences on all of our financial behavior, and you touched on it, is the way we saw money being managed and handled when we were growing up. Research shows that children who grow up in homes where things like saving and investing were never practiced don't practice these things as adults. You want to see how this is really playing out? The average American household is sitting on about $9,000 in credit card debt. I was on the Today Show yesterday pointing out the unfortunate fact that high school and college students are graduating with thousands and thousands of dollars in credit card debt. We do not teach basic money management in schools, and that should be against the law. I urge our lawmakers to put some of their effort there. There's great programs out there like Operation Hope's Banking on Our Future that can help to address some of these problems. But until we start to look at some of that root cause of the issue, financial illiteracy, we're going to find ourselves needing another bailout a few years from now. So I urge us to take this opportunity to really look at some of the causes of this problem.
Great. Thank you, Ms. Tisdale. Sure. Mr. Wade, NeighborWorks does homeownership counseling, which is a distinct category of financial education.
Sure.
Talk about that.
Sure. I think our experience would support the notion that consumers who were adequately prepared, by and large, are not in foreclosure today. Our network has helped over 150,000 low and moderate income folks become homeowners. Essentially the same characteristics that the subprime market that's in a meltdown, serve. And right now, and we fortunately have, in addition to using and partnering with mainstream financial institutions, We do have our own secondary market, and Mary Lee Widener is the president of that secondary market. And the loans that our groups help consumers get are performing fine. In fact, we just recently did a correlation between the most recent Mortgage Bankers Association data and their foreclosure numbers compared to the loans at our own secondary market. And the subprime loans are going into foreclosure 21 times faster or greater than the loans in the NHSA portfolio. So I think the evidence would suggest that if consumers get good pre-purchase education, they get in a loan that works for them, they buy a house that they can afford, it can work just fine. And one of the things you see today in the press, people have spoken to it, that there's a lot of blaming the victim going on. That if we hadn't loaned money to those people, this wouldn't be happening. And that's the furthest from the truth, because I think evidence would suggest that you can serve low and moderate income folks, you can serve them well, they can be successful homeowners if you do the right thing. And I know Congressman Waters and others have been in the forefront of trying to ensure that more of this is available, and it's available more broadly. I know the Urban League is one of the organizations out front on this issue. And the other thing I would say about the current crisis, clearly we need to have more counselors available to help consumers out of the mess that we're in now. And I would say one of the things that we ought to consider, if the government is going to purchase all of these assets that have these toxic loans in them, let's get a moratorium on foreclosures so we can take the time and help people out of the problems that we're in.
Thank you. Let's thank Congresswoman Waters, who's got another engagement, for her leadership and for being with us. Maxine Waters of California, thank you very much for your leadership. Folks, listen to this fact. While it is the perception and it's being promoted as what I call a disinformation talking point by certain right-wing interests in this country, that, quote, the cause of the financial crisis in subprime lies with minority and low-income borrowers. 2006 HMDA data, that means mortgage disclosure data from the banks, shows that the majority of subprime loans were originated to non-Hispanic whites. So let us disavow with great force that the reason for the subprime crisis was that, quote, there was now lending to African Americans and Latinos. We have to reject with fact and force that notion. The truth is that we were disproportionately as a community impacted by this. Much greater than our percentage in the population, much greater than our percentage as the total pool of home buyers. And the tragedy is, as you've heard, that many who could have qualified for a good, normal, conventional loan was sent to the rear of the office to the special man. And the special man had a special loan. And the special man got paid to steer people to the special loan. We need to understand and deconstruct that this problem does affect Americans of all races, but like so many things, it disproportionately impacts people in the African American community. I want to go to Mr. Bowman because there are so many terms and agencies that people are learning about today. Fannie Mae, Freddie Mac, Office of the Comptroller of the Currency, the Federal Reserve Bank. Mr. Bowman is with the Federal Deposit Insurance Corporation.